You know the story they always tell us. The ultimate goal for any startup is to build a forever company, a legendary unicorn. But what if the smartest play, especially for those earliest investors, is the exact opposite? Today, we're going to dig into a really powerful and, honestly, a counterintuitive idea, the built-to-exit strategy. And this quote, it just gets right to the heart of it. It's basically saying that for angel investors, the biggest wins don't come from those 10-year moonshots. No, they come from these focused companies that were built from day one with a clear and much, much faster exit plan.
Okay, so first, we have to talk about the story that every single founder knows by heart, the unicorn dream. I mean, it's the narrative that sells books. It inspires founders all over the world. And don't get me wrong, it is inspiring. But for an angel investor who's writing that very first check, that long, winding road to becoming a unicorn is just packed with risks that can completely wipe out their return.
So, if the unicorn dream is that risky, what's the alternative? Well, that's where we get into what you might call the angel investor's secret playbook. It really boils down to two totally different philosophies. On one hand, you've got the built-to-last marathon. We're talking a decade, maybe longer, chasing that unicorn status. And on the other hand, you've got the built-to-exit sprint, a super focused 3 to 5 year push toward a strategic acquisition.
Now, I want to be super clear here. Built to exit does not mean cutting corners or building something flimsy. It's a strategy that's all about intentionality. It's about creating something so valuable and so well structured that another company will want to buy it, and they'll want to buy it within a predictable and much shorter time frame.
But why is this shorter path so often the smarter one for an early investor? Well, it all comes down to some really powerful core advantages. Just look at this timeline. It makes the risk factor crystal clear, right? A 3 to 5 year exit means an investor's money is only exposed for a pretty short time. But a 10+ year journey, oh man, that means you have to survive multiple market cycles, countless funding rounds that dilute your ownership, and massive shifts in technology. The risk is just so much higher. So when you boil it all down, the built-to-exit strategy gives you 3 huge advantages. First, you get your money back way faster, which means angels can reinvest those wins into new companies. Second, it forces this incredible discipline on the founders right from the start. And third, and this is the big one we just saw, you dramatically reduce your risk by shrinking that timeline. But look, this isn't just some abstract theory. It's a real, tangible financial strategy. Now we get to the math. And this is where it gets really interesting for an investor.
So for a lot of these companies, especially in the B2B software world, everything revolves around one key metric, annual recurring revenue, or ARR. Think of it as the predictable, steady lifeblood of the business.
The very first signal flare that a potential buyer sees goes up right here. Hitting $3 to $5 million in annual recurring revenue is the milestone that officially puts a startup on the acquisition radar. It's like a big flashing sign that says, hey, look over here. But the whole game changes once you hit $10 million in ARR. I mean, it's a completely different level. At this point, you're not just attracting competitors who might want to buy you, you're getting attention from private equity firms, and you're even starting to open the door to a potential IPO. And this cable, well, it just ties it all together perfectly. You can literally draw a straight line from the ARR target to the potential valuation. So a company with, say, $4 million in ARR might get bought for $20 to $32 million by a bigger company in their space. But you hit that $10 million mark, now you could be looking at an $80 to $120 million exit. It's a clear, predictable path to a big return.
Okay, but none of this happens by accident. Not at all. It takes a really disciplined approach, and that discipline has to come from both the founders and their angel investors.
You know, the angel's real job here is to hammer this discipline in from day one. That means setting financial targets that are tied directly to that 3-year exit plan. It means pushing the founders to stay laser-focused on one industry, one product, one problem. And crucially, it means helping them avoid that huge temptation to raise too much money and bloat the company before they're ready. So when you step back, this completely flips the whole investment idea on its head. The angel's bet isn't really on a founder promising a global empire in 15 years. The real bet is on disciplined founders who can build a super valuable, acquirable asset in just a fraction of that time. And all of this leaves us with one final, pretty provocative question for every founder and investor out there. Is your startup built for a dream, or is it built for a return? Because you know what? The answer might just change everything.